NIO stock closed out Friday's session at $6.38 per share, down about 13 cents or just over 2%. The intraday range saw the stock trade as high as $6.51 and as low as $6.26, before settling just below the midpoint of that range. For casual observers, this might look like another down day in what has been a volatile few weeks. But when you zoom out, the picture is more encouraging. Despite today's dip, NIO has now closed above $6 for more than a week straight, and that's something it hasn't managed in more than 6 months. That fact alone tells us a lot about where NIO stands right now. For most of this year, the $5 line was a ceiling the stock simply could not crack. Every time it tried to push higher, sellers knocked it back down. But last week, NIO broke through that ceiling and hasn't looked back. It surged nearly 40% in the span of a few sessions, lifted by optimism around new product launches, short covering, and macro tailwinds from the Federal Reserve's dovish signals at Jackson Hole. Since then, it has chopped around between $6 and nearly $7, but crucially, it hasn't slipped back under $6. That is an important show of strength. So what was going on today? Why did NIO finish the week down? The first answer is the simplest. The market in general was trending down. Broader indices like the S&P 500 and the Dow Jones Industrial Average weakened on Friday as traders took a cautious stance heading into the weekend. When risk appetite fades, growth stocks like NIO tend to feel it more than others. That was part of today's story. The second factor is the lack of a fresh catalyst. Earlier this week, NIO's moves were fueled by optimism around its redesigned ES8 SUV and its mass market Onvo L90. Analyst commentary, particularly from Morgan Stanley and Goldman Sachs, added both questions and confidence. Questions around production ramp and profitability, but also acknowledgement of NIO's cost-cutting progress and long-term upside potential. By Friday, however, the narrative hadn't shifted. With no new announcements from the company, no analyst upgrades, and no delivery updates, there wasn't enough fresh fuel to push the stock higher. In the absence of positive news, the market defaulted to following broader sentiment, downward. Third, execution and profitability worries are still in the background. Investors are excited about the Onvo L90's potential, with some forecasting as many as 10,000 monthly sales by the end of this year, but they also know NIO needs to execute flawlessly for that to become reality. At the same time, the company remains unprofitable and may need to raise more capital to fund its growth. Those lingering concerns create a ceiling on just how far investor enthusiasm can carry the stock in the near term. But again, the bigger story isn't Friday's 2% dip. It's that the stock is holding above 6. Think of it this way, last week NIO tested a new breakout. This week, it proved it can defend it. That's how trends are built, by establishing higher lows and confirming support levels. $6 has now been tested multiple times and held each time. As long as that continues, the breakout remains intact. For traders, that means the line to watch is clear. $6 is support, $7 is resistance. If NIO continues to consolidate in that range, it builds a base for the next move higher. A decisive break above 7 would open the door towards 750 or even 8 in the medium term. A break below 6 would put the bullish thesis in question, but so far, buyers have stepped in every time the stock has flirted with that level. For long-term investors, the story remains about fundamentals. The ES8 keeps NIO relevant in the premium space, going head-to-head with Tesla's Model Y. The Onvo brand gives NIO a shot at mass-market scale that could meaningfully increase deliveries. Battery swap infrastructure continues to differentiate the company and give it a unique competitive edge. And with the Fed leaning toward a rate cut in September, the macro environment looks more supportive than it has in months. Friday's action also reminds us that NIO remains a high-beta, volatile stock. It can swing 5 to 10% in either direction on very little news. That volatility is part of the package. But the key is whether the swings are creating higher lows and higher highs. Right now, that's what we're seeing. A pullback from 670 to 638 is normal consolidation after a huge rally. What matters is that the stock didn't collapse back under 6. Heading into next week, investors should keep an eye on a few things. First, any updates around ES8 pre-orders and the Onvo production ramp. If NIO can show traction with those vehicles, it will strengthen the bullish narrative. Second, broader market sentiment. The Fed's September decision is still a few weeks away, but every piece of economic data between now and then could move markets. Inflation prints, jobs numbers, and consumer spending data will all matter. Third, delivery numbers. September's delivery report will be closely watched to see if NIO is starting to translate product hype into real volume. In sum, Friday's dip was less about NIO and more about the market. The real takeaway is that the stock has now held above $6 for over a week, a feat it hasn't managed in months. That stability is a show of strength. It tells us that the breakout is still valid, that buyers are still present, and that the stock is consolidating in a healthier range. So here's the bottom line. NIO closed the week at $6.38, down about 2% on Friday. But step back, and you'll see a stock that has surged nearly 40% from its August lows, defended $6 multiple times, and established a new range between 6 and 7. That's the kind of resilience that builds confidence in a longer-term recovery story. The coming weeks will determine whether NIO can take the next step, pushing through 7 and beyond. But for now, the message is clear: the breakout above 5 wasn't a fluke. 6 is the new floor. And that makes Friday's decline less of a concern and more of a reminder that even in the face of volatility, NIO is showing strength it hasn't displayed in a long time.